Right. So today we're going deep on something a little different.
Yeah.
We're going to be looking at how businesses make those big financial decisions.
Mm-hmm.
And we're going to be doing it all through the lens of a good old-fashioned Excel spreadsheet.
Oh, yeah.
So,
It's exciting.
yeah, exciting stuff, right? So this spreadsheet we've got, it's for a company called Able Ltd.
Okay.
And it basically outlines this project they're thinking about taking on.
Right.
And they're trying to figure out, is this going to be worth it or not?
Mm-hmm.
So our mission today is to kind of like break down how they use this thing called net present value
Yeah.
or NPV
NPV.
to figure out if this project's a smart move or not.
Right. So it's all about figuring out, if they're going to spend some money up front,
Right.
will they get a good return on that investment?
And is it going to be,
Yeah.
a profitable venture for them in the long run?
Exactly.
And the interesting thing is,
Yeah.
we're going to see there's a little twist in this one.
Okay.
It involves something called scrap value,
Interesting.
which we'll get to a little later.
Yeah.
But it adds a whole other layer to this whole calculation thing.
Looking forward to it.
Okay, so let's start with the basics.
Yeah, let's break it down.
Right from the top of the spreadsheet, we see that Able Ltd.
Mm.
is considering this project.
Okay.
And it's got a pretty hefty upfront. Cost $300,000.
That's a big chunk of change.
It is, right?
Yeah.
So they really got to make sure this is worth it.
Right.
Now the project's expected to run for 5 years.
Okay.
And at the end of those 5 years, it's estimated that they can salvage some of the assets or something
Right.
and get a scrap value of $20,000.
Okay.
So that's like money they get back at the very end.
Yeah, at the end of the project.
Then we see the project is supposed to bring in $120,000 in extra revenue every single year.
Each year.
Oh.
Okay.
But of course, there's costs involved, right?
Every business has costs.
Exactly.
Yeah.
So they estimate an extra $30,000 in costs per year.
Per year.
And finally, a key piece of information. The company's cost of capital is 10%.
Hi.
Now, cost of capital, that's kind of a jargony term.
It can be a little bit, yeah.
So think of it like this. It's basically the minimum return
Yeah.
that Able Ltd. Needs to make on any investment
Right.
for it to be considered worthwhile.
Exactly. Like, if they can get a 10% return just by putting their money in the bank,
Yeah,
then this project needs to do better than that
absolutely.
to justify taking the risk.
Right, so 10% is their benchmark.
Exactly.
Okay, so now let's get into the nitty-gritty.
Yeah.
This whole NPV calculation.
Okay.
So we've got all these future cash flows coming in.
Right. We've got those revenues.
Yeah.
We've got the scrap value at the end.
But as you alluded to earlier,
Yeah.
we can't just add up all that future money and call it a day,
You got it.
right? Because $1 today is worth more than $1 tomorrow.
Absolutely.
Right.
That's the time value of money.
Exactly.
Yeah.
So how does this spreadsheet account for that?
Well, that's where the discount factor comes in.
Okay, the discount factor.
Right. So basically, it shrinks those future earnings down a bit
Right.
to account for the fact that, it's further out in time.
So how's that work in practice?
Okay, so let's take a look at the spreadsheet.
Okay.
First, we see that Able Ltd.'s got that 10% cost of capital.
Right, we talked about that.
And then the spreadsheet calculates something called net revenue for each year.
Net revenue, what's that?
Well, it's pretty straightforward.
Go ahead.
It's basically the revenue they bring in.
120,000,
Exactly, minus those costs of 30,000.
leaving 90,000 in
You
profit.
have $90,000 per year.
Gotcha. So far, so good.
All right, so now comes the discounting part.
Okay.
So this discount factor, it changes every year based on that 10% cost of capital.
So it gets smaller every year.
Exactly, because money further in the future is worth less in today's dollars.
Right. It's like inflation, but for investment decisions.
Kinda, yeah. It's like saying, okay, if I had that money today, what could I do with it?
Got it.
So the spreadsheet takes this discount factor,
Okay.
multiplies it by each year's earnings.
What?
Mm-hmm.
And that gives us the present value.
So it's like translating future money into today's money.
Exactly.
Now, I noticed something else in this spreadsheet,
Okay, what's that?
the scrap value thing.
Ah, yes, the scrap value.
Yes, that $20,000 they get at the end of the project.
Okay,
right?
exactly. So
So-
after the 5 years are up, they sell off whatever's left
Yeah,
over.
like the equipment or whatever.
Yeah, exactly.
Yeah.
Maybe some leftover materials.
And they figure they can get $20,000 for it.
Right.
So how does that get factored in?
Well, the spreadsheet discounts that scrap value back to its present value as well.
Just like the yearly earnings.
Precise.
So it's all about bringing everything to today's dollars.
Exactly.
All right, so drum roll, please. What's the final verdict?
The moment of truth.
What's the NPV?
All right, after all those calculations, the spreadsheet spits out an NPV of
Yeah.
$53,589.24.
Whoa, hold on, 53,000.
Yeah.
But is that good? Like, what does a positive NPV even mean?
Like a good sign, a very good
So,
sign.
like a thumbs up.
Basically, yeah.
Okay. A positive NPV means the project is expected to make more money than Able Ltd's cost of capital.
So more than that 10% benchmark we talked about.
Exactly.
So it's like saying this project is more worthwhile than just taking that 300 grand and putting it in a savings account or something.
Exactly. It's likely to generate a better return.
So is that it? Does the spreadsheet just say like green light, go for it?
Well, based on the NPV, yeah, the recommendation is to accept the project.
Makes sense.
But remember, it's all based on the assumptions in the spreadsheet.
Right.
If those change, the NPV could change too.
Well, that's a good point.
Like, what if those costs end up being way higher than they thought?
Yeah. Or if that scrap value turns out to be a bust.
Exactly.
So what's the takeaway here for our listeners who maybe aren't making million-dollar business decisions, but still want to be smart with their money?
Well, the big lesson here is the time value of money.
Right. $1 today is worth more than $1 tomorrow?
Exactly. And when you're making big financial decisions, whether it's investing in a business or even just deciding how to save for retirement,
Yeah.
you got to think about how the value of your money will change over time.
And this NPV thing, it's a powerful tool to help you do that.
Exactly. It lets you compare apples to apples even when you're talking about money you'll earn years down the line.
This has been really eye-opening.
Yeah, it's always cool to see how these concepts play out in the real world.
So listeners, next time you're facing a tough financial choice, remember what we talked about today
Yeah, think about that time value of money.
and consider using NPV to help you make the smartest decision.
You got it.
All right, that's our deep dive for today.
Until next time.
Thanks for listening.
Bye.